The sanctions and trade environment will be increasingly volatile moving forward. Leading organisations must be able to understand and adapt to sudden shifts in policies to ensure they maintain compliance and protect their business interests. However, keeping up with the new sanctions regulations can become difficult for affected institutions due to the rapidly changing and complex regulatory environment. Some of the key implementation challenges highlighted to me by financial institutions include the following. Firstly, the volume and complexity of advisory cases, in particular capital markets transactions, wind downs, and trade finance transactions. The disparities between the underlying sanctions regulations are contributing to this challenge. Secondly, the identification of relationships with specially designated nationals, SDNs, especially within the wealth management and corporate and investment banking sectors where complex company structures are common. Thirdly, the determination of risk appetite. Examples include determining how to treat clients where the connection to the SDN is through control, or the SDN ownership is below the 50% threshold, or the SDN nexus has been recently removed through divestments or resignations. At number 4 is the ability for the sanctions control framework to cope with the increase in demand and complexity. For example, the higher alert volumes, the frequency of list changes in customer and transaction screening, and the added complexities associated with dual-use goods screening. Lastly is the performance of historical transactional lookbacks for Russian transactional flows and newly designated SDNs to determine whether any suspicious activity reporting is required. Current political events require financial institutions to review their compliance programs and optimize them accordingly. The more robust the sanctions program is designed, the less likely the institution will be to commit a sanctions violation.